Let's move on and talk about the real estate space in India, which is buzzing a whole lot, by the way, if you've been keeping an eye on the volume data across players, across regions, not only in the Mumbai region, but NCR, South, especially in Chennai, Bangalore. So we thought of getting a discussion going on the real estate space, but from a different angle, from the REIT angle. Aravind Maiya, CEO of Embassy REIT, is joining us now. It's listed, of course, so you can see the stock price as well. Aravind, afternoon, and thank you very much for joining us on the show. Now, real estate is doing very well. We'll talk about what your view is right now, where in the cycle are we. But interestingly, commercial as well as and residential both are doing well, especially the premium. And increasingly, awareness is rising that if you want to play the India bull run story or the India growth story, which appears more prolonged, commercial realty is a good angle to play. What are your thoughts on commercial real estate in India, the demand supply, the factors at play on it?
Sure. Good afternoon, Ajay. Thanks for having me. I think in terms of commercial, as we speak now, we are sitting today on exciting times, if I can say that, after going through a bit of a lull because of COVID. Last calendar year was a bumper year in terms of gross leasing, close to 60 million square feet of leasing across the core cities in India. For calendar year 24, we are looking at potentially 65 million square feet of gross leasing as per some IPCs. Overall, a lot of these, as we speak now, strong RFPs in the market, close to 20 million square feet, and 50% of those RFPs are in Bangalore. Why I insist on Bangalore is because we as Embassy REIT are predominantly located in Bangalore. Close to 75% of our existing properties and the upcoming properties are in Bangalore. So as we speak now, we are sitting on good, exciting times, and a lot of these demand is coming from growth in global captives. We can speak about that in due course, but big picture, that's what's happening in the commercial real estate space.
Is one of those big factors which is aiding the sentiment, but as you said, you're right now predominantly in Bangalore, but you do have plans to foray into Chennai as well. At least that's what you articulated in your analyst meet as well. Plus, I think there's a pool of assets on which you have the ROFO rights as well, or right of first refusal, that is. Are you looking at capitalizing on that? Talk to us about your expansion plans.
Sure. Anisha, I think in terms of expansion plan, let me split it into two parts. One is what we call as organic growth, and second is, of course, the inorganic, which is where new cities come into picture. Just in terms of organic growth, there is good times ahead. Why I say that is we are today at 85% occupancy. Pre-COVID, we were at 95. So even if you were to consider 95% as stabilized occupancy, we have a good journey where the NOI and distributions can go up just from the existing space what we have. Plus, we are constructing close to 7 million square feet in our existing parks where the land is already paid for. So we're looking at in excess of 20% NOI yields from these existing properties. So that's the second lever of organic growth. Outside of it, we anyway have the 15% once in 3 years contractual escalation. So this is one part of the growth story, which is already there. Then, of course, comes the inorganic growth. We really didn't do much over the last 2 years because, overall the market sentiments were down. The stock was down. As you are aware, and the viewers must be aware, we as REITs distribute all the cash back to unit holders, which means we always need to raise new capital if we need to grow inorganically. Of course, the price is corrected now. So that's the reason why we are looking at growing inorganically. And Chennai is, of course, a sponsor asset where we have ROFO rights. Outside of the ROFO assets, of course, we continue to evaluate from third party as well. So that's the second bit of inorganic growth, which we believe will start again playing out for REITs in due course. So put together, organic plus inorganic, you should be looking at good net operating income growth as well as distribution growth in the years to come.
Sorry, just a follow-up there. The street is expecting your net operating income that you talked about is expected to grow handsomely, might grow at the compounded annual rate of 12 to 13% and might be looking at like a 4,000 crore number soon. Is that realistic? And when you say inorganic growth, you're open to that. What size, which areas, which kind of geographies would you look at tapping?
Sure. I think, Anisha, what I'll do is I'll refrain from giving any future numbers. As we speak now, for FY24, we have given a guidance where the NOI will be in excess of 3,000 crores, and from there it will, of course, grow. But in terms of cities, if you look at India and commercial real estate, it's broadly 6 cities, which is Bangalore, Pune, Mumbai, NCR. Other than that, it's Chennai and Hyderabad, where we are not there today. So of the 2 cities where we are not there, Chennai is one city where we definitely want to enter. Hyderabad, we believe as Embassy REIT, it's a little bit of skewed in terms of supply versus demand. So we might look at it a little more carefully, but we'll continue to grow in our core city, which is Bangalore. Plus look at some of the other cities within those 5 cities which I spoke about.
Aravind, we can clearly infer the kind of growth you would, clock depending on the kind of guidance you've actually made. But I want to understand from you, what kind of conversations are you having with your prospective clients? If you could share, who are your current big clients, and when you are already engaging in acquiring or building in new regions, you must be already in discussion with some of the clients to have better visibility on the kind of spending we'll go ahead with, right?
Sure. I think that this is 2 parts of the question. Ajay, I think in terms of clients, as I kind of alluded to very briefly, it's largely the global captives which are taking up space. And when I speak about global captives, there are different sizes. You have absolutely new entrants coming to India and taking up space as small as 15,000 to 30,000 square feet. Versus you have guys who have entered India many years back, and they've been growing phenomenally, and they're looking at space in excess of 500,000 to 1 million square feet. So they are covering the whole spectrum of space. And just a bit about global captives, I think what they're doing is, this is no longer a cost play. Core business functions are getting outsourced to India from these captives, largely because of course, availability of STEM talent as well as other talent at scale in India, because of which they're growing their presence. So now global captives are actually called as transformation hubs, what they're setting up in India, and that these are the guys who are growing. So this is the place from where we're getting all the demand. And in terms of moving to the second part of the question, it depends. There are few cases where we do build to suit, where even before we start construction, you have the tenant, we know exactly what we need. But more likely than not, we start a construction, and during the course of construction, tenants come in and ask for space. And of course, then comes the third stream where the building is already available and people look at existing space. So it's a mix of all 3. But as we speak, just referring to our third quarter, we did 3 large pre-leasing for 3 buildings under construction, ranging from 650,000 to close to 850,000. These deals were not in the market for almost 2 years, but that's back now, which is a very positive sign.
So the bad news, the downside of a good phase in any sector is that the raw material also doesn't come that easy. What are your thoughts on that, be it refurbishments or actual land? Because everything has gone up, right? And the visibility it's on the higher side. How are you negotiating this factor?
Sure. Just one point which I want to clearly clarify on REITs is, REITs are the real estate investment trust are more stable product for multiple reasons. And one of the reason is, we can't really buy vacant land. There are conditions under the SEBI REIT regulation which does not allow us for speculative transactions. 80% of our overall portfolio always needs to be completed and rent generating, which means we are not really in the market to buy land. Whereas, the various developers are in that game where they buy land, they construct, and potentially in future, they could offer it to the REIT for sale. So we are more looking at buildings which are complete, or it could be larger parks where there is some bit of construction complete and some bit of future growth potential. So these are the type of deals we look at. So we are, I would say, in a bit of a different market. And just on the second part, just in terms of overall cost, I think over the last 2 years, the costs have gone up, but things have stabilized. It has fallen down as well over the last few months. So I would say cost has been pretty stable. But the beauty of commercial real estate is, we are kind of inflation hedged. The rental prices are expected to move up largely in line with inflation, or sometimes even higher, including the 5% which is contractually built in. So it kind of takes care of the cost escalations which have happened or could happen in future. That's our take on this.
And Arvind, just before I let you go, a quick word on the SEZ denotification. How are you looking at planning all of that? Because I do understand there's some GST angle to it as well. So given all of this, what's the plan at Embassy REIT now?
Yeah, Anisha, it's a very positive move, first of all, because a large part of space was not marketable, being SEZ. Now, all of it, effectively, we're looking at it as non-SEZ. From a Embassy REIT point of view, we are in the process of demarcating, as they call it, close to 1.8 million square feet of space. We are in the process. In terms of cost, it kind of ranges, but ballpark can range between 350 to 450 rupees per square feet. But just converting the math, right? If we are looking at denotifying or demarcating a space in Bangalore where the rental is in excess of 100 rupees, you could recover this cost in a matter of 4 months. Versus in some other city, like let's say a Pune or a Noida, where we are in the specific micro markets, we will still recover those costs in a matter of 7 to 8 months. So overall, a very positive move from the government for which we are very thankful. And that was one of the last headwinds which was there for this sector, which has also gone away. So it's a good move.
Arvind, we'll let you go on that one. Thanks very much for joining us and explaining. It's a brilliant product, yet to catch up the fancy of India Family Office and big HNIs who are always looking at realty with, they just love that space, right? And, Anisha and I were just discussing that if you play real estate in India for the long run, why go for the physical hassles? REIT is the best way to go about it. But of course, we'll together raise the awareness on